So as we just heard, starting today for the first time in 30 years, South Korea has imposed a fuel price cap to tackle the oil price shock. For more on this, we're joined today by Professor Park Min-jung, Professor of Department of Business Administration at Kumoh National Institute of Technology. So Professor Park, thanks for coming on today. How might this fuel price cap bring down prices for consumers, and how might it affect oil companies here in South Korea?
Yeah, the Korean government is considering imposing a fuel price cap for the first time in about 30 years. In the short term, this measure could help reduce the immediate burden on consumers, especially when global oil prices rise rapidly. However, there are also potential side effects. Price caps can put pressure on the profit margins of all refiners and distributors, which may affect market incentives and investment in the sector. Additionally, maintaining a social policy may require government intervention through tax adjustments or subsidies, which could really increase fiscal pressure. Therefore, while the measure may be effective as a temporary stabilization tool, it should ideally be combined with long-term strategies such as improving energy efficiency and accelerating the transition to alternative energy sources.
Right, and because of this oil price shock, International Energy Agency member states, including South Korea, agreed to release a record amount of oil from the reserves, but oil prices still didn't go down. Why is this?
Even though member states of the International Energy Agency, including South Korea, agreed to release a record amount of oil from their strategic reserves, oil prices did not fall significantly. This is because oil prices are influenced not only by current supply, but also market expectations and geopolitical risks. First, the releasing strategy reserves is mainly a short-term stabilization measure. Markets understand that reserves are temporary and cannot replace long-term production capacity from major oil producers. Second, the ongoing geopolitical uncertainty surrounding the Russia and Ukraine conflict has created a risk premium global energy markets. Investors and traders expect the possible disruptions in supply due to sanctions, transportation issues, or prolonged conflict, and these expectations tend to keep prices elevated.
I see. And oil prices actually climbed above $100 per barrel today. And some analysts even say these oil prices will not fall to pre-war levels even after the conflict ends. Do you think oil prices will remain this high?
Many analysts now believe oil prices may not return to pre-war levels even if the conflict ends, and there are several structural reasons for that. The first, the global energy markets has already undergone significant supply realignment. Sanctions on Russian energy exports and shifts in trade flows between Europe and the Middle East and Asia have changed the structure of the market. Furthermore, secondly, the investment in new oil production has been relatively limited in recent years. Energy companies have become more cautious about long-term fossil fuel investments due to both market uncertainty and energy transition policies. And finally, the transition toward carbon neutrality, in most carbon neutrality, is reshaping the industry. While renewable energy is expanding, the adjustment period can actually lead to tight supply conditions in traditional energy markets.
I see. And Professor Park, before I let you go, on tariffs, the Trump administration has launched a new trade investigation into South Korea and also 15 other economies. And this is aimed at replacing reciprocal tariffs. How might this trade probe affect the Korean economy?
The trade investigation launched under the administration of Trump targeting South Korea and several other economies could introduce additional uncertainty into global trade relations. South Korea's economy is highly export-oriented, so any potential tariff changes or trade restrictions could affect key industries such as automobiles, steels, and semiconductors, particularly in the US market. At the same time, Korean companies have already developed relatively diversified global supply chains and production networks. This means they may be able to adapt by adjusting production locations or supply routes. So ultimately, the issue reflects a broader trend of rising protectionism and strategic competition in global trade, and South Korea will need to respond with flexible trade strategies and stronger international cooperation.
I see. All right, Professor Park, thank you so much for coming on today. We appreciate it.
Thank you.